Hi, this is Marco Schwartz. In this review, we are looking at Digilo, a European crowdfunding platform focused on mortgage-backed loan opportunities. The short version, Digilo has clear loan metrics, a low entry amount, and a credible regulatory story. But it is still lending, so we need to judge the return against borrower risk, collateral risk, and platform transparency. On the homepage, Digilo positions itself directly, funding made easy, with mortgage-backed loan opportunities across Europe. The key numbers shown are a €150 minimum investment, expected annual returns of 9 to 12%, and terms from 12 to 36 months. That is the starting promise. But the real review starts with the project data and risk disclosures. So, who is this for? Digilo is aimed at investors who want fixed income style exposure to real estate backed loans without buying property directly. It is not a savings account, and it is not liquid like a listed ETF. You are taking borrower, platform, and collateral risk, so position sizing matters. This section gives useful context on Digilo's background. It says, the team has been active in real estate since 2008, business loans backed by real estate since 2009, mortgage lending since 2016, and credit brokerage since 2023. That does not remove risk, but it is better than a platform with no visible lending history. This section highlights the credibility story. Digilo says it is licensed and regulated, including ECSP licensing and Bank of Latvia oversight. It also points to more than 15 years of lending experience, a trusted network, and a proven track record. These are useful signals, but not guarantees. Regulation improves transparency. It does not eliminate borrower or collateral risk. One important caveat: regulated does not mean protected like a bank deposit. Regulation usually improves process, transparency, and disclosure. But the borrower can still be late, collateral can be difficult to recover, and returns can be delayed. I see regulation as a positive filter, not as a reason to ignore risk. Here we can see the investment projects page. The example is a Latvian project with about €33,000 requested, 52% LTV, 12% interest, a 36-month term, and a low-risk label. It is 16% funded with 2 investors. This table is useful because it shows amount, LTV, rate, term, risk, funding progress, and time left. Opening the loan detail page gives more context. We see the same amount, a 36-month term, Latvia, 12% interest, 52% LTV, and a balloon schedule. The risk section shows collateral of €63,000 and a low-risk category. The visible description says the project refinances a loan linked to self-employed activity in Latvia, but full details still require account access. Before investing in any loan, I would check 5 things. What exactly is the collateral? How conservative is the valuation? Who is the borrower? What is the repayment source? And what happens if the borrower is late? The visible metrics are useful, but they are only the beginning of due diligence. The filter drawer is a useful practical detail. It lets users filter by loan ID, risk level, LTV range, term range, and interest rate range. That matters because you do not want to browse only by headline yield. Filtering by LTV, duration, risk, and rate helps keep the process more disciplined. The FAQ explains onboarding. Digilo describes itself as a licensed crowdfunding platform for real estate secured projects with 9 to 12% annual returns and a €150 minimum investment. Registration requires sign-up details and identity verification. It also mentions Lemonway as the EU payment provider, plus ID and proof of address requirements. Inside the account, I would still check for portfolio tools like AutoInvest, reporting, and any secondary market features. AutoInvest can help diversification, but it can also make investing too automatic. If you use it, the filters need to be strict, and the allocation per loan should stay conservative. The risk warnings page should not be skipped. Digilo states that crowdfunding investments involve risk, including partial or full loss of invested funds. It also says these are not deposit products and are not covered by deposit guarantees or investor compensation schemes. The page then breaks out general investment risk, borrower credit risk, and collateral risk. This section reinforces the positioning, connecting investors with real opportunities, backed by experience in real estate secured lending across Latvia and the EU. The visible bullets repeat real estate activity since 2008 and property secured lending since 2009. That is a credibility signal, but each loan still needs individual due diligence. My overall view is cautiously positive, with conditions. Digilo has a clear niche, visible loan metrics, a low minimum investment, and a credible operating history story. The risks are still borrower default, delayed recovery, and limited full detail before sign-up. I would treat it as a small, diversified portfolio position. This final section summarizes the selling points: experienced team, low entry threshold, passive income, transparent insights, broad project range, and regulation. I will leave links to Digilo, the documents, and extra resources in the YouTube description.